Okay, good morning, everyone, and welcome to what is now the 73rd issue of the Coffee Microcaps Morning Meeting. You're all very welcome. For anybody who's joining us for the first time this morning, my name is Mark Tobin. I'm the founder of Coffee Microcaps. I'm just going to quickly run through a few intro slides, and then we're going to get straight into it with our first presenter. I would like to mention our sponsors for all our virtual events here, Coffee Microcaps, Demase Asset Management. If you're looking for a small and microcap fund manager, please check out their website for their PDS and financial services guide. You'll find all the information there. Alternatively, please reach out to Stephen or Michael. Compliance and disclaimer slide. For anybody joining us for the first time, the companies we generally have presenting on here every week, capped under 300 million in revenue and approaching cash flow break even, or indeed are already profitable, generally from outside the resources and biotech sector, what I like to call industrial microcaps, which covers microcap tech, financial services, consumer goods companies, anything basically that's kind of not resources or biotech. Structured this morning's webinar, 20 minutes of a preso, 10 minutes of Q&A, so 30 minutes for each of our presenters. If you do have any questions for them, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate the questions to our presenters. Please note the webinar is being recorded and it'll be posted on the Coffee Microcaps YouTube channel tomorrow. Follow us. You can pretty much get us on all the social channels. Twitter is probably where we're most active. YouTube, as I said, for the recording of this webinar, and indeed all the other previous ones. We've got well over 100 company presentations on there now. LinkedIn, and I also do a free monthly newsletter which you can subscribe to on the Substack platform. Our first presenter this morning is Simon Mather, CEO and Executive Chairman of Prime Financial Group. And coming in at 9:30, we've got Joe Demase, CEO of Webcentral, and Glenn Diamond, the CFO of Webcentral. So without further ado, I'm going to stop sharing my screen and hand you over to Simon. Simon, if you want to start sharing your presentation, I'll let you know when I can see the cover slide. I can see the cover slide of your presentation now. You're good to go, mate.
Fantastic. Thanks, Mark, and thank you for the opportunity today, and thank you for those that have joined. As Mark rightly said, my name is Simon Mather. I'm the Managing Director and CEO of Prime Financial Group. We are an advisory and capital firm. I'm really pleased to run through for you what we believe is a very solid set of results for FY22 as part of really what has been a 3 to 4 year great trajectory for our business. And we're very optimistic about what FY23 through to FY25 looks like as we scale our firm. So what I'll do is I'll just quickly jump into, first of all, the financial performance and the highlights for 2022. So importantly, we had an increase in our underlying EBITDA, up 15% to $7.8 million. That's off the back of a 23% increase in the previous year. Importantly, we've been able to really start to get our revenue growth accelerating. Our revenue is up 18% to $26.3 million. That's all organic revenue growth. We've also had a good result with respects to EPS. It was up 14%, but in fact would have been up closer to 30% if it hadn't been for us subletting part of our Melbourne office space, which meant that we had an expense through the P&L for a reduction in the right of use asset for about $500,000. Our dividends are up for the year. Our dividends were up 57%. I look forward to showing you through what the trajectory has been over the last 3 years with the dividends. Importantly, we're also forecasting for our dividends to be up a further 36% in FY23. We've been able to maintain our margin. We have an operating margin of about 30%. That'll move within 1 or 2% generally, but 30% is maintainable. That's an increase from 19% 4 years ago. So heading in the right direction. We've also been able to reduce our debt. Our debt is down 26% to 5.2 million. So it's at a very moderate level now, 0.67 times underlying EBITDA. And we have very strong operating cash flow. Our cash flow is up 11% over the preceding period to $6.1 million. And we're using that strong operating cash flow to increase dividends, reduce our debt, and we also have a buyback in place at the moment. Next slide. So some other important information about our business. So our team has grown quite substantially over the last 12 months. It's up 30%, and we do advocate for a flexible operating structure with our team. That has meant that in our 3 core offices, which I'll touch on shortly, in Melbourne, Sydney and Brisbane, we don't need as much office space as we once did, hence the reduction in that footprint in Melbourne. That will allow us to have a saving in cash flow and at the P&L level of around about $300,000 into FY23. We are accelerating our organic and our inorganic initiatives. We have been very disciplined around focusing on growing our business organically, but we are now also looking to increase the size and scale of the audience that we speak to for all of our services. So inorganic will form part of the future. Dividends I've spoken about, including that increase forecast for FY23 of 36%. And as I mentioned previously, we do have the share buyback in place. We've spent probably as at today around about $850,000 acquiring our own shares. In terms of who we are, and just to put a little bit more detail there for you, as I said, our business is Melbourne, Sydney and Brisbane. Our core purpose is really about empowering our core clients, so business owners, family groups, to achieve their aspirations, why they went into business. And we really do that by virtue of a model that has 4 key services. And those 4 key services are accounting, business advisory, wealth management, where we manage around about $1.1 billion, SMSF, admin and advice, and also capital and corporate advisory services. But where we seek to differentiate is really in how we don't isolate or segment those particular things. We think about our clients being clients of the total firm, and we work very hard to integrate the total stack that we've got available for each and every one of our clients. We refer to ourselves as an advisory and a capital group, and we do have 130 team members across those 3 offices, but we also do have a growing presence in the Philippines, which is a core part of our team and our strategy. And we will be focusing on growing both organically and inorganically in our 3 core locations. With respect to our capital structure and a few comparisons for those of you that follow the space, market cap's around about $40 million at the moment. We do have that net debt of $5.2 million, that 0.67 times underlying EBITDA. Our share price at the time of release was about 19.5 cents. We're trading at about 10 times on the basis of historic 1.93 cents per share at the EPS line. And we are paying a fully franked dividend or yield on the basis of 19.5 cents of 5.6%. A really core component of what we think about for the future, given we are a professional services advisory group, is to make sure that your team have a clear ownership in the outcomes that you're trying to co-create together. So we are pleased to say that 44% of our firm is owned by our key management and staff, and that is open to anyone that has been with our firm for at least 12 months. So there is a clear democratization of how we think about the ownership structure, and we do encourage team members to participate in that. In terms of our top 20 shareholders, 69% of our register is with those top 20 shareholders. We do not currently have any significant institutional shareholders on our register. The companies that we compare ourselves with on a very frequent and regular basis are listed there. Probably the closest comp for us is really Kelly Partners Group. There are some close similarities, but we do probably have more diversity to our revenue, which I'll touch on in a second. But they are very similar in terms of what they do for their clients. We are not a dealer group or an AFSL only provider, which is probably more where, without speaking for them, a Centrepoint, a Diverger, or prospectively Sequoia and Count Plus might sit. We are an advisory firm seeking to deliver multiple services to clients and to obviously have a very healthy operating margin, and for the team to own part of the future there, helping for us to drive and create. In terms of key financial information, 22 v 21, as I mentioned before, revenue is up 18% to $26.2 million, EBITDA at 7.8 million, a margin of 30%, and our final dividend that will be paid on the 30th of September of 0.6 cents per share. Just to break down that 26.2 million in a little bit more detail, as I mentioned before, our revenue growth had been around that 4 to 5% as we were laying the foundations of building some of these newer service lines and components to our offering as we sought to diversify our revenue streams. But what we've seen in the last 12 months is the way that those collective service lines have come together and how the team are getting better at presenting those opportunities to our clients. Hence the reason why I've had 18% growth in revenue, and you can see that below across the 4 different service lines, which I'll touch on in a minute. But importantly, if we just focus our attention on the left-hand side there for a second, 80% of our revenue is recurring in nature. That does allow us to continue to invest in new service lines, and we have had that focus on organic revenue growth. But ostensibly, the way that we focus on building our business is in 4 key ways. One is organically with the existing service lines that we have. 2 is by finding new revenue contributors, people that have got capabilities and skill sets that may not currently exist and that can come into our firm that want to be part of an ownership structure and what we consider a reasonably dynamic group. On top of that, we will roll out new service lines and we will also consider acquisitions. So we have 4 key ways that we look to grow the firm, and that has materialized in those bottom 4 graphs, if you like. So over the course of the 21 to 22 year, our accounting and business advisory revenue line grew by about $500,000 from $9.9 million to $10.4 million. Our wealth management division, which is our second largest division, after a period post Home Royal Commission, has now returned to growth. That increased its revenue from $7.6 million in 21 to $8.5 million, so about $900,000 increase there, which is very encouraging. Our capital and corporate advisory division, which has now been around for about 5 or 6 years, continues to grow at circa $1 million a year, which was impressive, and we are very optimistic about the direction of that part of our business. And our SMSF admin, compliance and advice service line has increased by $1.3 million. That's the newest of our service lines. It's been around about 4 or 5 years now. And again, we're very optimistic about the growth trajectory for that part of our business. So we have nice diversification across those areas. We have those great clients that sit in the middle that we look to manage more and more for across those 4 key disciplines. Next slide. So expense management has been a pretty core component to us being able to expand our operating margin and to increase our EBITDA. We have been reasonably frugal over the course of the last 3 years, and we have centralised some core services out of Melbourne with the support of our Philippines team to make sure that we have got enough headcount and team to go out and deliver the services that we need to grow our revenue base. And that has been the substantial investment that we've made over the course of the last 12 months. Our overheads are up 14% when you exclude the impact of that right of use asset write down, and that has substantially been team. And that has resulted in, as I said before, the increase in EBITDA from 21 to 22 of 15% and 20 to 21 of 23%. So we feel that we're in a more of a growth mode now than what we've ever been in, but we're also very cognizant of continuing to pay solid and increasing dividends for our shareholders. In terms of the operating margin, I've touched on this already, but as I have mentioned, we've had a progressive improvement from 19% to 30% over the course of the 4-year period of time. 30% is maintainable. Our debt has come down materially. It peaked at 30 June 2020 at 9.8 million at approximately 1.8 times underlying EBITDA. It's now down to 5.2 million and will continue to reduce subject to acquisitions. That's now 0.67 times underlying EBITDA. Cash flow has improved almost 400% from FY19 to FY22 to 6.1 million, up 11% for the year, as I mentioned before. With respects to the dividends, we're quite pleased with the way that this chart presents. As I mentioned, the dividend payment will be on the 30th of September. We have got the record date of 5 September and the dividend reinvestment plan has been ceased. Obviously, that would not be consistent with a buyback. We don't want to be issuing any more shares than we need to. And as you'll see there, the interim dividend for FY22 was 0.5 cents per share. The final will be 0.6, and we are forecasting an increase to 0.7 and 0.8 for the FY23 year. We are paying out around about 55 to 60% of maintainable earnings. There is nothing terribly significant here on our balance sheet that I haven't probably already covered off, or from a cash flow perspective. So I won't spend a huge amount of time here, but our biggest asset is really goodwill and intangibles, being that we've obviously acquired businesses over time and our 25-year history. I'll jump onto the next slide here. Clearly, improving shareholder returns is very important, but you only do that if you're looking after your clients. And we're very pleased that if you think about, I guess, the last 2 or 3 years where you've had to move from a very much an on-site operation and giving and delivering professional services to substantial being off-site and then hybrid components thereafter. Over that period of time, we have continued to get higher and higher net promoter scores, which is essentially just a client's willingness to refer you to someone else or advocate for you. And we have a very good group score of 43. That's puts us in the great category. So we think that part of our point of difference is also why we get good feedback from our clients, that integrated one connected firm mentality and doing more for our clients. So very pleased around that. Obviously, giving back to the community is another important part of our responsibility as a good corporate citizen. So we do provide support to the various organisations listed there, whether it's Oz Harvest, Mayday, Share the Dignity and Give It, and supporting flood victims. But we also encourage our team to take a day every year to give back to the charities that they really believe in personally. We also have brought on board an ESG consulting firm to assist us to make sure that we are relevant and that we are considering our ESG responsibilities, and that will form part of our strategy into FY23 also. Next slide. In terms of our strategy, this has probably been a little bit boringly consistent over the last 3 to 4 years, and I think that's where that discipline of remaining focused has enabled us to have probably a really good series of 4 to 5 years of results since we repositioned the business. So in terms of our strategy for the future, it will remain pretty consistent. You know, it will be about finding the right clients, encouraging our team to find more clients, deliver more services to those clients as they come in, to continue to engage our team as owners of the business, making sure that we use technology to understand how our business is performing and where the opportunities, the cracks of opportunity can be opened up to continue to grow our firm, which will be both organic and inorganic, as highlighted previously across those 4 key areas. Our people are our biggest asset. We want to keep looking after them, and we want to make sure that we service our clients exceptionally. So in terms of revenue, if we're thinking about our firm at a $26 million turnover today, over the next 2 to 3 years, we want to continue to scale even at a faster pace, at closer to 50 million turnover of the coming couple of years. So we are very focused on continuing to differentiate and scale our firm. When we think about the outlook for Prime, again, we want to make sure that we are as transparent as possible in terms of what the trajectory looks like. We do expect to, in FY23, continue to increase our earnings and grow our revenue. We are expecting revenue growth of at least 15% into FY23. We do expect our underlying EBITDA to grow by at least 5 to 10%, and we are expecting EPS growth of at least 15%. I just highlight that we did outperform against our guidance last year. Just probably worthwhile noting that. So we are trying to be at an early stage of the year as transparent as we can as to what we think the opportunities will be. We'll continue to explore the inorganic and the organic growth opportunities. The dividends will be up as we are forecasting by a further 36% on top of that already reasonably impressive dividend payout ratio and percentage. Our debt will remain within the target range of 0.5 to 1 times underlying EBITDA. The buyback will remain in place. Obviously, we have a particular view about the value of our shares at the moment, so we'll continue to buy back where we think that that is below fair value. And the team I've already mentioned, and I think that's a core component. And over coming years, if the team could own a greater component of what we're doing as they earn future equity by virtue of driving performance, then we see that can only be a good thing. So really, very pleased with how the team have performed over the course of FY 2022. Encouraged that we can maintain the trajectory into FY 23, but also very cognizant of the fact that we're a 40 mil market cap business that is probably trading at a lower multiple than some of our peers, and there will be opportunities for us to scale what I would consider quite materially over the next 2 to 3 years to closer to 50 million turnover, whilst maintaining a very similar operating margin at that circa 30%. I'm going to pause there for a second, Mark, because I think that's probably where we'll halt for the moment, and I might sort of defer back to you if you have any questions or there's anything else you'd like me to cover.
Yeah, we've got one question already from the audience, so let's start with that one. It says, "Hi Simon, great results. Cash conversion has been lagging and lockup has come up 100 days from 70 a few years ago. What is the long-term lockup days target?" I'm not sure if they're referring to debtor days there or creditor days.
Yeah, it would be most likely just our working capital lockup, I would have thought generally. So yeah, 100% correct. We probably ended up having a bit of a blowout for say circa 25 days, higher than what we would have liked. We had some material debtors at the end of the year, and vast majority of those have now already been paid. So our working capital did expand more than I would have liked, but we would expect to see that back closer to the target range of sort of 90 to 95 days. If you were to put that in perspective, the wealth management division doesn't really have a huge amount of working capital requirements. The majority of the working capital is across the accounting, the SMSF, and also the corporate advisory division. And probably worthwhile noting that the May and June periods for us were significant. So the growth in revenue was obviously a lot larger this year than previous years. So I think those things combined probably pushed it to being higher than I would have liked, but we are expecting to be able to draw that back closer to target range over the course of the next 6 to 12 months.
And then a question on the SMSF business. I think the question is, do you do any work in SMSF auditing, or is it more an extension of the advisory business, or maybe both?
Yeah, so we don't do any audit. So we outsource all the audit function. We don't have that function anywhere within Prime. We are not an audit firm. We are focused on that division services our direct clients that have SMSFs, doing the compliance, the tax side of things, and also the advisory where appropriate. But it's also a B2B structure where there are other accountants and financial planners that can no longer get the capability internally to do some of the work, and they might be subscale. And effectively what they do is they outsource it to us, and we complete that function for them. It's actually a very fast growing division. And interestingly, there has been a good period of time where there's a move probably away from SMSF, where it was kind of flattening for a period of time in terms of growth. But there's actually a whole new generation that are now looking at SMSFs because of digital assets and various other things. So we're very busy in that division, and just to give you an idea, we'd actually expect that division to go from what was circa 2.7 to 2.8 million to at least 3.8 million in turnover in FY23, just given the volume of work and opportunity ahead of us.
Just a question for me on the debt, Simon. Is the plan to get it down to zero, and then as the debt reduces, what does the capital then flow into? Further buybacks, special dividends, or do you just kind of keep powder dry for potential acquisitions, or a combination of all three?
Yeah, I think your final point's right, and I guess we try to get the balancing act correct. I don't think that we'll end up with zero debt, but part of that's going to be determined based on the number of opportunities that are out there. And we haven't really undertaken an acquisition for 4 or 5 years, and we have been very focused on, once we set our footprint across Melbourne, Sydney and Brisbane with the 4 core service lines, we've been focused on growing them organically. But I'd be surprised if there wasn't a transaction that took place in the near term. And we'll obviously be cognizant of keeping our debt in check. And I don't see it going over 1x, but if there weren't acquisitions, it will probably come down to almost zero pretty quickly over the next 1 to 2 years. But again, we have the buyback in place because we're probably cognizant and a little bit surprised that we're not trading at a higher multiple than what we currently are. And I think that the awareness of the firm hopefully will increase over the next little bit, and maybe there is the possibility of a re-rating. So, at current prices, we're very comfortable to buy back, but we will continue to increase dividends as well. So it's a bit of a juggling act to take a look at the circumstances and make sure we get the right trajectory in each one of those key areas.
Okay. And then we had Brett Kelly on not so long ago. The question here about can you talk about your business in comparison to Kelly? So maybe a little bit of a deeper dive on a compare and contrast between you and Kelly. Say, like, I mean, obviously the accounting business by revenue is, one of your larger segments, but are you guys targeting the same customers, or would you have a slightly kind of different customer focus to what Kelly would have?
So firstly, at the outset, so much respect for what the Kelly Partners Group have been able to achieve. Since listing, it's a seriously impressive positioning that they've been able to achieve. So firstly, respect from all of us at Prime on that front. And I think if and I'm always very careful to to be accurate in what I say here, but I think that the Kelly Partners business is probably more 90% at the moment around that accounting and business advisory piece. They are building out the wealth piece, whereas we started as a wealth business that moved more into accounting. We actually were originally a wealth business that did joint ventures with accounting firms, which was our background, and helped those accountants build a wealth management capability. That evolved into building our own capability around accounting as well, having our own direct wealth management business and now corporate advisory and SMSF. So we're becoming a more evenly balanced business across those 4 service lines. We have a relatively small number of accounting clients that typically pay us a higher fee than what might be the norm for more suburban style accounting firms. We've got around about 900 clients in our accounting and business advisory division for about, say, $10 or $11 million of turnover. So about $10,000 fee per client. So we have some quite business orientated clients in that space, and we look after some pretty solid family groups as well. I don't know the number of clients that the Kelly Partners Group has within their firm, but I can talk to what we have there. On the wealth management front, we typically look after clients with an average fund balance of between $1 and $3 million. And but more recently, what we've done is taken our capability across accounting, wholesale investments, etc., and build out a virtual family office style structure for people with larger fund balances. And we've been able to accrete some great clients that have closer to 25, 50, and $80 million of funds under management. And we provide a more complete service where they probably wouldn't justify having their own internal resources for that. So we see that as being an opportunity for the future as well. But absolute respect to the Kelly Partners Group. They have a great market cap. They're accelerating. We're accelerating, and hopefully there's a point in time where we are sort of trading at similar multiples to what they trade at.
And then just a quick final one, Simon. Obviously, you mentioned the Royal Commission and a kind of a fallout from that, and it's been in the works more broadly is, this financial planning and kind of cliff that's coming with planners and people in the wealth management space more broadly leaving the industry, and this big gap opening up. In terms of attracting talent into your business, are you finding it a struggle? Because I'm sure every other group is also looking for kind of similar talent.
Yeah, look, I think the last 5 years for anyone in wealth management stroke financial planning has been pretty challenging. It's been a complete recut of how the economics play out, and that's seen clients starting to pay for things that were somewhat subsidised under previous models. we've felt pretty privileged along the way because we've always had that model where the client's paying us directly for what we do. And so although you might have had some small commission income that came off 2 or 3 years ago, clients have substantially paid us for the work that we do. So I think that's a good model. I think it's also good to have an ownership structure in place where talent these days, they want flexibility, in my view at least anyway. They want flexibility, they want to be part of something, they want to own part of what they're helping to create. So I think we've got the right thematics playing out. And I think as a growing organisation with a group of services that are appealing more broadly to an advisor's clients, we're probably not a bad place to land. There are fewer advisors than were around as education standards have changed. We're not struggling to find talent today. We have been pretty good at mentoring and bringing tech members through from being in client services to junior advisors, etc. But we need to continue to reinvest in that program ourselves. That the best talent is the homegrown talent that are part of the firm's fabric and believe in what we're trying to do. So we've got to continue to recruit and bring people through the business and provide opportunities for people in other divisions that might want to move across divisionally also. So we're okay for now, and the demand for services in financial planning are not changing, and there's fewer advisors, and so the economics are probably starting to be more balanced and improving for advisors and wealth firms than what it would have been 4 or 5 years ago.
Simon, we're just up on time. Actually, we've just gone slightly over. I know you have a busy day, so I will let you go, and thank you very much for joining us. And we'll keep an eye out for further updates from Prime.
Fantastic. Thanks for the opportunity, Mark, and everyone have a good day.
Thanks, Simon. And Joe, if you want to start sharing your screen, I will let you know when I can see the cover slide of your presentation. Can't see anything coming up as yet, Joe.
No, that's all right.
I think it's coming through now. Yeah, and if you just want to go to full screen mode, Joe, just so we get the full effect there. Yeah, there we go. Perfect.
Thanks, Mark. Sorry, I thought that you were pushing the presentation up there.
No worries.
You got me a little off guard. Thank you, everyone, for coming along and listening to this Webcentral presentation, the full year results for FY22. We've put out our 4E and this investor presentation. The results are unaudited. We're comfortable with where the results are at. It's just really it's timing from the auditor's perspective and getting all the sign-offs. So we expect that to be done and completed in the annual report out in early September. So we've had a really strong year. Revenue up 5.2%. There's lots of exciting things happening, the revenue growth perspective. EBITDA continues to grow, and really for us what we're focused on is growing revenue, growing EBITDA margin. So 18.2% up from 16.8%. Our target range for that is sort of 22-23%, so 17.6 million for the full year, excluding some of the acquisition costs and the share-based payments, and gross margin maintaining around 60.6%. And we've just announced that we'll reinstate the dividend. So Webcentral or Arc Group, prior to us acquiring it and changing the name, doing the merger, used to pay a dividend. 5GN used to pay a dividend. So we'll do a full year dividend of 0.5% this year, and then basically we'll look at how much of the share buyback we take up. So we've got a share buyback underway at the moment, and we've got a number of acquisitions that we're looking at as well. We usually do those a combination of cash and equity. somewhere between sort of 25 and 75% each way, depending on the target and what they're looking at. So, and we've sold our Cirrus shares, which is 18.4% of that on Monday as well, which is strengthening our balance sheet and our cash reserves. So we've got about 10 odd million in cash. We've also got a $10 million CBA facility pre-approved for acquisitions. So that gives us a fair bit of firepower in that space to play around with potential acquisitions as they rise, and also gives us flexibility around a dividend and what we do from a buyback perspective. The results, so quite a few things happening here. We've seen really strong growth in cloud. A lot of that's being driven by the Webcentral consumer customer base. So if we think of our business as consumers or really small SME type businesses, we've got about 330,000 of those clients. Most of them have a domain name with us, an email account, and they'll host at about 6% host their website with us. So all those areas of hosting, email, and domains, as you can see, are growing. We've actually been able to fix our attachment rate for domain sales. So we were seeing about 6%, as I said, in hosting when they buy a domain. We're now up to 25% attachment in new domain sales. So that's really going to help that cloud hosting area and email grow. As I said, domains is up. I'll talk a lot about the .au domains and where we're at with that, how we're punching a bit above our weight with domains. Networks is small growth in networks. Data centers down. We've had a bit of a shift from some people moving from data centers to cloud. So it's a competing product that we see within our business across our customer base, where they might move from data centers to cloud or vice versa, depending on what's happening there. Managed services is down by 1.4 million from the previous year, and you'll see their hardware's down by about $4 million as well. So obviously, a lot of people in the tech space will know about the supply chain issues we're seeing with major vendors, so predominantly Cisco, HP, anyone who involves basically a chipset. A lot of our managed services, there's a lot of project work in that. So that's our field staff. So there's about 80 field techs across 12 offices around Australia. They support our IT customers, but also install and upgrade hardware and software infrastructure. So if there's a slowdown in hardware and software getting that equipment, then we'll see a slowdown in those managed services, or some of that manual or the labour warm bodies project work, we refer to it as, will slow down and decline as well. So we've probably got about $2 to $3 million in hardware that we've sold that we're waiting on to be delivered. The time frame is coming down. It's sort of anywhere from 4 to 3 or 4 months. It's sort of starting to come back now to 2 months, and what it normally operates is about a month from ordering that you'll see that hardware delivered, and then we can get on with some of the project work. So we don't have a lot of bench time with our managed IT group. We've got a number of internal projects that we run. So when they're not out there working with customers and servicing our customer base, and obviously they get priority, then they're working on some of our internal projects across the larger base, because there's a lot of IT systems obviously across our business. Digital marketing is it's improved, but it's still relatively flat, and will be a real focus. And again, I'll refer to that with the domains. The domain new customer take up and .au domain growth is really going to drive our digital marketing. Other income is, prior to us acquiring the business, there was a number of assets or companies sold off, and this is the other income relates to some of those separation agreements. So it's non-core. We expect that to decline or continue to decline as we focus on our own business and less on third-party services that are non-core to what we do. As I said, gross margins relatively strong. and continues to grow. We've got a number of initiatives over the next 12 months that'll continue to look at cost savings and around our COGS and around our OPEX, cost savings around software integration into our own data centres, and some better buying around what we do, but also we're automating a number of our services. So we've just, for example, Webcentral, we've introduced chatbots. So we'll expect to reduce some of our offshore support as well. So there's a number of initiatives around managing and staying on top of our operating and COGS in that area. And then I think I've covered that. So then we just had the impairment of goodwill of about 11.4 million, and really, again, that's probably over impaired there. In my opinion, we've probably taken a really conservative approach with impairing those assets. Obviously, we haven't had a lot of growth during COVID around that asset sector, which has really been the data center and data center networks area of our business. So we've taken the impairment there. And then in the detailed accounts, a bit more breakdown around, obviously, our 4E is a little bit messy with the consolidation of both businesses and some options, the accounting treatments and how we treat options and those sorts of things. But happy to answer some questions if people want to dig down into that detail. So really exciting this year. The governing body out has launched the .au domain. So basically, if you've got webcentral.com.au, then you want to grab the .au domain. Our research says that only 26% of ASX listed companies have taken up their .au domain. So you wouldn't want someone coming in and setting up a website, bellpotter.au and taking some of their business. So I strongly suggest that everyone else goes out there and registers your .au domain. You got to the 20th of September. If it's with us, great. But if it's not with us, register that. It's like it's almost like the internet started again, in my opinion, around this, where we're certainly, we're seeing, it gives you an opportunity. So for us, we'll go and register, hosting.au, networks.au, some of these other more traditional names would then help with your search. So the real three reasons you want to grab it .au, it's Australian, so it identifies you from Australian perspective. So Google, if you do a Google search in Australia, you will it will call up or organically rank a .au domain ahead of a .com.au because Google knows you're doing the search from in Australia. You're after an Australian product, and the most Australian businesses or recommendations it's going to throw up to you in its algorithms is a .au domain. So we've seen about a 30 to 40% increase in our organic search by moving from webcentral.com.au to .au, and it works. So we probably were more luck than good management on that behalf. We decided to support the .au and change our domains. Certainly our rankings dropped initially, but we've seen a big take up or big growth in our organic search, which then reduces all your online spend that you need to do. It's also a security measure. So it's obviously quite easily, if someone says an email to me, jd@webcentral.com.au, if they then get the .au, they can just say jd@webcentral.au. Then all of a sudden, I don't notice that they've dropped the .com, and all of a sudden there's some security risks around, whatever that might be. We all know the horrifying stories of people hacking emails and those sorts of things. And it's also a brand protection. As I said, you don't want someone, spinning up a bellpotters.au and directing all that investor traffic to some other smaller financial institution down the road. So it's really important. You can see there, we actually thought that we'd be really strong take up at the start when it was first launched in March. But what we're seeing now is the .au domains as we get closer to the 20th of September really increasing in demand. So, just this month we've just cracked 40,000 domains. So we've sold quite a few in August. I think we'll get about 14,000 .au domains in August. So People are buying those anywhere from 12 months to 2 years in advance and securing those. So that's quite exciting. We think that'll be a real run on those domains as people become aware of the risk of not securing it. And for $15 a year, it's it's a real no-brainer from when you think about the amount of business you can miss. So as I said, our adoption rate for hosting has gone from 6% to 25%. 25% is the industry average. When we look at our online or the Webcentral domain business, we do very much mirror what GoDaddy's doing. They're certainly the leader in the marketplace. So we're analysing all the tricks that they've implemented, and we're adopting those to really catch up to getting to the quality and to some of the numbers that they're achieving. I think they're running at about 23% EBITDA. So we fixed up our hosting. We're doing some great stuff around our email and OX mail products. So Microsoft are discontinuing an online web-based email product. So we're launching our own OX mail. We expect some significant savings in across those accounts. We're about to roll out MBN. So we've got our own staff on our MBN product at the moment. So we'll start pushing that out to our 330,000 customers. We've already surveyed them. We know what we think that the take-up rate's going to be around that. So that's really exciting. And what's important with the MBN product is that we already have, it's not we're building something new. This is what we do every day. We run and operate telecommunications networks for a licensed carrier. We have plenty of spare capacity on our infrastructure. As a hosting provider, we push data to the internet. As an NBN user, you're downloading data from the internet. So it fits perfectly, and we better utilise our infrastructure by having those customers on board. So internally we're targeting sort of 3,000 NBN users in the first 12 months at roughly about $100 a month. So you can do some numbers on what we're going to get from growth around that. So that's really exciting. We've launched our CloudPort product. So think of this as a Megaport competitor. So again, we own and operate some of our own data centers. We have fibre in the ground to 50 data centers across Australia. There's about roughly 80 data centers, 90 data centers in Australia. So we've connected up the major data centers with our own fibre optic cable. And so we really, that product will be really profitable, and it's really exciting. We can then leverage that to go to international, some of our international hops as well, Singapore, LA, New Zealand, Tokyo.
Attention, the emergency warning system is about to be tested. There is no need to take any action.
Sorry, guys. What are the
This is a test only. The first tone is the alert tone.
I'll just...
No worries, Joe. Just keep going once the beeping is stopped.
All right, I think that's over. And I also do apologise. We've got new cladding going on our office building outside, so there is a bit of drilling noise. We hope that they would have stopped so I could do the presentation. But anyway, we'll continue on. So dark fibre rollout, as I said, to those 50 data centres across Australia. So we sell dark fibre as a product. So you put your own equipment on that fibre optic cable between two locations, go as fast as you like. And then we've got the competing product to that, which is a managed network product, which we call CloudPort. Again, similar to Megaport, where you can log on, you can order your port, and then you can determine via our portal what speed you get to the internet, what speed you get to LA, what speed you get to Singapore, what speed you get to another data center, either in that state or in another state across Australia. So we have 100 gig of capacity going to all the different states of Australia into the major data centers. So that's really exciting. So we'll launch that. There's a wholesale event in Melbourne next week. So we're really excited by launching that. And the expansion of chatbots. For some of you on here, I know chatbots have been around for a while in the Webcentral system. This is new that we've launched. And again, as I spoke about with some of the cost savings and better customer service, which we're really focused on. is being able to self-service. And some people don't want to wait or get on a phone call or don't want to send an email. So we're seeing really strong attach and take-up rate in the chatbot. Revenue by product. If I just talk about these, what I want to talk about here really, I spoke about the growth or the change, but it's the margin, the actual margin we're achieving today, and then what our incremental margin is. So again, we put someone on our private cloud infrastructure, we get 75% of incremental margin. That infrastructure is existing, it's in a data center. We're wearing all the costs for that infrastructure. So the margin is really high. Domain names with the domain name sale and some of the attachment products that we put to that, like domain transfer lock and domain protector, we're seeing about a 70% incremental margin there. Network and voice, again, it's our own infrastructure. So when we're putting customers on our infrastructure, it's about 80 points of margin. If we're buying an NBN service, will be about 25 points of margin. So that will probably, that margin will increase, and then I think it'll stabilise around that 80 points. But these are for new customers. Again, data centres, we're covering all the costs of the data centre, all the infrastructure is paid for, all the staff, the rent, all those things. So any new customer we put on, it's really high margin. Managed services, about 35 points of margin. Again, we're a bit low on some projects. Projects are better margin than our ongoing IT base. Digital marketing, against the labour business, so about 35 points. And hardware, software, anywhere between 10 and 15 points of margin is what we usually get on that. There's been a bit of a push, but again, we've sold less, so the margin is a bit higher. Next slide. Sorry, I'm going a bit quicker just to get on top of time. This really layers our product. So our domains, all our cloud hosting, and then if you look at the managed services, all those applications that we provide to customers sit on our own infrastructure, because that's where it makes the highest margin. If it's on a third-party provider, then it's about 20 or 30 points of margin. So we're constantly looking for acquisitions, and we're constantly moving our base onto our own infrastructure. Relatively simple story, 330,000, those SME customers, about 2,500, what we call mid-market corporates or enterprise. We've got, a handful, about 20 high-end, what we would call ASX-listed clients, but the rest of those are mid-market. So think accounting firms, law firms, other businesses in that, some financial institution, small financial institution providers, some travel, a fair bit in the education space. We're strong in pharmaceutical. So it varies depending on which part of the country. We're in 350 staff, as I said, across Australia, across 12 offices, and we're the third largest domain provider in Australia. I spoke a little bit about the .au, just to give you a couple more stats on that. So with the campaign that we're doing, the majority of what we want to do from a marketing perspective is upsell and grow our existing customer base. 330,000 customers, so we're constantly pushing new products into that existing base. But we've been doing some radio and creating some awareness around the .au and with the Saints Football Club this year. And what we're seeing is a 10 to 12% take up by new customers into domains. And then from an industry average, we're running, so as a domain provider in Australia, we have a market share of about 8%. But with the .au launch, we've been running at about 18%. So we're punching well above our weight with the new .au domains. And we think that sometime in the next 12 months, the .au domains will take over the .com.au domains. So we're really excited by that continued growth. You can see here increase in ARPU year on year. Again, it's bundling some more products in, making sure that they've got hosting, making sure they're taking up our email products. We've done a lot of work with customer journey. So you buy a domain, and then you over time you get additional emails, upselling and cross-selling for additional services. Again, strong growth in our email and web hosting is continuing to grow, and it's a real focus for us because it is a high margin part of the business. Renewal rates still remain pretty strong. You'll see there, domains are an interesting product because a lot of people do buy a domain for 12 months or 2 years, and then they'll go, well, that, you know, I'm not renewing that because it didn't take off. We see a lot more attachment rate or renewal rate with websites and email hosting, but domains is the entry point for new customers. So everyone buys a domain first. That's the most important part of the journey of our customers, and then you know, the more products we can get into that customer base, i.e. NBN or a cheaper OX mail product, then you know, the stronger the attachment with the customer. This slide really just talks through our network and our capacity that we have on our infrastructure. So our infrastructure is really important to us, but from a market perspective, it's supporting our customer base. So again, the more our customer base grows through the Webcentral and the enterprise brand and wholesale of 5G networks, the more we fill up our infrastructure, the higher our margin, and obviously we get revenue growth and cash growth. If I talk about cash flow, we had a strong last quarter. Again, there was a lot of cash hung over from the previous year around delayed government payments, PFG, GST, those sorts of things. We've had a number of leases that we've terminated, which had been accounted for, which we had to pay out, or there was exit fees along related to those leases. So no impact to EBITDA, but an impact to cash. And then, as I said, the domain, probably the .au domain take up, we thought would be a lot stronger in that first half. If you think about a 6-month period from March to September, in the last financial year, we thought that take up would be a lot stronger and therefore to generate a fair bit more cash, but we're starting to see that now. As I said, we've exited the Cirrus investment, and we sold out at 3.2 cents a share, and that generated another 5.5 million of cash inflows. And this year we'll reduce our capex. So we've had a real big capex program over the last 2 years. As you'll see, sort of $7-8 million. That's rolling out that fibre network. It's investing back into our data centres and renewing a lot of the infrastructure that sits in our data centres to make sure that we can provide high availability, and also upgrading a lot of our cloud, upgrading our cloud capacity and renewing our cloud capacity. So we expect that that capex to drop and then stabilise at that sort of 3 or 4 million. The network, again, the fibre network extended by another 50 k's this year. So we've got a little bit to do in Sydney towards Macquarie Park, and that outer area of Sydney. There's a number of data centres out there that we're connecting up. There's another deck that we put out to the market the other day that talks directly to our fibre network and where that is. So if you're interested, I suggest you have a look at that. And then probably the only other thing here is I spoke about the deferred tax liability and our property leases liability. So that sort of covers off those. Deferred revenue and is an interesting one. Everyone pays in advance. We buy the domain for the customers in advance, but we need to put that revenue to deferred revenue. So that item's about, I think it's about $22 million against about $6 million of COGS. So and then we've done as I said, the impairment for goodwill. Outlook, so 108 to 118, again, quite a big range. We're not sure exactly what the take-up of NBN will be, and at $100 a month per customer, we've put a bit of variation in for that. Again, we think that the take-up of the .au domains will be quite strong. We're expecting another 40,000 on top of the 40,000 we've got already to the end of October. That's our internal target, so we've given ourselves a bit of room there. Very confident on the EBITDA range, and we've as we've said, we've paid a final dividend. We'll look at interim dividends and continuing the final dividend for next year, depending on how much of the buyback we do and what happens around acquisitions. And then here's a cap structure. So open any questions.
Thanks, Joe. I'll kick off. I've got like one or two questions, but we might even run out of time. But we'll see. Just on the acquisitions, you said you're always looking around for acquisitions. In terms of the the lines of business, and you guys have a lot. There's probably 7 or 8 different lines in there. Are you looking at anywhere in specifically, to like build out digital marketing, or to build out the hardware business more, to kind of give a bit of balance and a bit more diversity to the cloud offering and the domain offering? Or is it literally totally opportunistic where something just might come up?
Yeah, so it's pretty strategic. What we like to do is, so we'll pay anywhere from sort of around four times EBITDA. But what we want to do is we really want to drive. We want that so say we bought something for $2 million with 2 million EBITDA, we pay $8 million for that. What we're looking for is another 2 million in EBITDA during due diligence. So they need to be someone who's utilising data centre space, utilising cloud infrastructure, or utilising network with a third-party provider. So it is pretty narrowly focused. If they fit within that criteria, or they've got parts of the business that service that, they might be a managed IT service or managed services business that uses network, cloud, and data centers. So then we'll look at what those synergies are. But what we're trying to do is double that EBITDA sort of within the first 12 to 18 months on acquisition.
And then a question on the .au domains. For the people who've signed up already, I think you said 40,000 or whatever have signed up to date. Typically, how long do those people hang around for then? Is that, that you said they're paying upfront for probably a year, but, taking into churn over a period of time, do 60% of them still customers, 3 years down the track, or what's kind of the fall off rate?
Yeah, so I mean, it's a little bit of an unknown. We can use the experience from the UK and New Zealand. Who I think the UK was about 8 years ago. New Zealand was 3 or 4 years ago that they adopted the .nz or the .uk. What my gut feel is that we'll see a real transition to .aus over the next 3 years. So that means that people will need to kind of keep both. If they're conscious about the brand, they'll need to keep their .com.au as well. Although I think over time it'll become less of a brand or a domain. So we're pretty confident in the short term that we'll keep those domains. What's important is that we attach an email address to that domain really, really quickly, and we get a high take up of that, because once people start using a domain on their email, then they'll keep the domain because they want to keep the email address because everyone knows that email address. So even obviously we want them to build a website and do e-commerce and all those sorts of things. But the important one is getting an email account attached to that domain. Okay,
great. Joe, I think we'll leave it there because I am conscious we're bang smack in the middle of reporting season, and we're at the open for the market. So thanks very much for joining us. And as you say, we'll keep an eye out for the annual report in the next couple of weeks.
No worries. Thanks for your time. Thanks, everyone. Cheers.